This course is going to be about finding the money for your venture. And the session content covers both impact investing and normal philanthropy kinds of thinking. What I'm going to talk about right now is a fairly new concept called impact investing. It's finally people are putting together the more traditional marketplace resources that were focused primarily on profit, along with the potential philanthropy resources and looking at how those can help encourage social and mission-driven entrepreneurs. So impact investing is one of the keys to being able to make social entrepreneurship viable. And lots of people are working on it. What I'm going to be talking about is an overview of where we are today. So nonprofit organizations, foundation, and government are all going to need to have this new access to what traditionally was focused only on for-profit dollars, because the kinds of problems that we're facing are going to need such a broad array of solutions. And we've been talking about that all through this course. So there's lots of experimentation going on about how to make these kinds of things work. And so what I want to explain now is sort of all the pieces of this and what's going on that brings those together. The term impact investing actually started getting used in 2009, so it's fairly recent. And it from the investor side, it's looking at investments that create both positive financial return as well as positive social and environmental impact returns. And both of those are actively measured. And that's an important piece of the puzzle. The other piece of the puzzle is that the investor themselves has an intention of making sure that whatever they do with their dollars, how those dollars work, are getting the kind of social and environmental returns that their values say they want to make sure happen. So there's two organizations that have been working on this for a while. World Economic Forum, that global meeting was one of the early places where those conversations were happening. But also now there's this thing called the Global Impact Investing Network, and that network is bringing together all of the resources and thinking so that it's an easy platform for anybody who's intrigued with this to be able to access and begin to understand how all the pieces fit together. So I just want to talk through what this core characteristics are for impact investing a little bit more. Like I said, intentionality is one of the keys. Investors are more and more making statements like, I want to make sure my dollars that I'm investing aren't working against my values about the environment or my values about helping people, or are not being invested in ways that actually are encouraging slave labor, or a whole myriad of things that people are concerned about. And those expectations are getting well defined. So anybody working in the capital markets are having to be able to respond to this return expectation that goes beyond capital return. And the other thing is there's this range of return expectations, and it varies depending on the kind of asset investment that's being made. So it can be across how my stocks work. It can be how my portfolio is making loans. It can be how I personally make philanthropic decisions. So all those pieces are starting to get amalgam together. Whoops, went too far. There we go. So I want to spend some time just talking about this from the investor viewpoint. We haven't talked about that kind of perspective in this class, but in order to understand this, I want you to get your mind into thinking you've got $10 million that you invest on a regular basis, and you do have a set of values that are really important to you. And so from the investor viewpoint, their thinking is, how do I make sure my philanthropy thinking, I give money, I give 5% of my assets every year away, and those are framed in, I want to make sure they're making positive social change, I want to make sure that they are working on environmental issues. And then you want to make sure that the investment dollars are not undermining all the work you're doing in the social side. It's sort of those two pieces coming together. So, but also the investor saying, I'm not, for my investment dollars, I need to make enough of a return that I'm continuing to be able to grow the dollars I need to be able to live, or grow the dollars that I want to give away. And so how do I work to get my passion aligned with my financial return needs? So that's what we're talking about. So one way to think about this is one of these 4-part charts. Let's do this. So if you look at this side, it's the thinking that goes into what is the market return that I want to have. Traditional investments, you can say, I want to make as much money as I possibly can, and I want to make sure that it's at least the same of what I get in a traditional stock market investment. That makes that pretty high. But some people could say, you know what? In order for what I want to do with my money, I only need a return of under 5%. And there's a few people who think that there are some individuals who would actually say, all I need is to get my investment back at 0 return. So there are people all along this whole range. Now, when you look at this edge, this is about the social returns. And so depending on how committed people are to what the social return is, it can be low, it's like do no harm, or it can be high. I want to make sure the maximum change happens, and as you go along this edge, it becomes clearer and clearer that you may have to do the most philanthropic kind of activity with your money, those grants, instead of an investment where you get money back. So it's this kind of continuum that people are beginning to think about. Now, when you look up in this box, that's the one where the real impact investing is happening. People can choose to say, I want financial returns first. I've got to make sure that's in place. And then look and say, I want to make sure that my value return is also there. Now, according to this chart, there is this concept that I'm going to check impact first and invest my money there. Most of the people who are working in this field are saying this is really not happening very much, but it has potential as we get smarter and smarter about how to marry these two things together and how to design ventures that actually can meet that dream. So again, keeping on the investor hat, that once the investor said, okay, I want this kind of return, let's just say I want to make sure I get 5% return with my $10 million. Then the question is, so how do you articulate your values? This chart of categories is a common one that's used by investment advisors in traditional bank and trust investment offices. Pretty large categories, but it begins to frame what people are looking for. The other thing about this list is that there are social investment opportunities in each of these categories. So affordable housing is one that has been around for a long time. Lots of different ways of structuring investments so that you're helping to create affordable housing, tax credits, lots of other kinds of things. Microfinance is another one that becomes pretty obvious as an investment opportunity. Small business development is another one. But the health and wellness is a fairly new one. Education is a fairly new one. And then this other, of course, is everything else in between. So the length of experience in being able to do these kinds of investments and the kind of experience about whether there is a real return or not also depends on how long the sectors have been working on social for-profit and return-focused kinds of strategies. When you look at environment, again, these are the same kinds of things apply. There are more business structures that are working on environmental solutions. So if you get into sustainable agriculture, there's more and more opportunities to be able to invest in agriculture production, clean energy production, solar investments, those kinds of things. So on the environmental side, it in many instances, it's easier to find investment opportunities where you get a real return and you can get in that upper quadrant box. Okay, so these are the questions the investor is walking through. What return do I need? How much of the portfolio should I be using? Is it all my 10 million that I'm going to make sure matches all my values? Or do I want to say 10% of my 10 million is going to go to zero return, and 50% is going to go to 8% return, and then I'll be able to counter so that my total income needs meet that. So sometimes, I'm just going to go back to this slide. So sometimes if you're thinking about your whole portfolio, people might say, well, I'm going to do impact investing with a percentage, traditional investments I'm going to do with a percentage, and philanthropy I'm going to do a little bit, and overall I want to make sure I get 5% return on that 10 million. All right. So these are the options. This is what's the newest piece of this whole puzzle. And every kind of asset investment that an investor can make is now possible for use in this kind of impact investing. So stocks, you can say, I want stocks so that they match the sustainability goals I personally have and my ethical values. Or that I have excluded, I don't want my money to go to anything that is in a specific country, or I don't want my money to go to anything that is in this kind of energy sector. Bonds also, and bonds have been around for a long time. Municipal bonds is an alternative way of getting loan money for nonprofits and government, and we'll talk more about that in the class. Social impact bonds is one of the newer options that's been around. Minnesota's been one of the early explorers of this, and we'll talk more about what those are like as we're in class. Private equities, that's stocks. Venture capital investments, so there's both public stock investments, but there's also private stock investments. Private debt, you can get a loan from somebody and promise to pay it back with specific return and in a fixed period of time. And co-op ownership is another kind of asset investment opportunity that Minnesota has been around for a long time, but it's also being considered in this array of assets. So I've talked some about this already, but the choice first that the investor makes is, do I want to make a loan where I get the money back, or am I making an equity investment, higher risk, I'm buying stocks, or I'm a private investor and I expect a return? They operate a little bit differently. There's more experience in the nonprofit sector taking on debt. There's more experience with debt in government as well, where equity has traditionally been something that's only on the for-profit side and still continues to be on the for-profit side. But we've talked about public benefit corporations, and equity in public benefit corporations is becoming a new option in this array. So here's how it gets laid out. If you want to think about a continuum, there's the below market returns and the at or above market returns. And these vehicles tend to be split between those kinds of choices the investor makes. Grant support, obviously below market return. You get the tax deduction, and that's kind of it. Program-related investment or debt, these are from foundations. Program-related investments enable foundations to be able to invest from their basic corpus, the original dollars that set up the trust, and those dollars can legally be invested in something that matches the mission of the foundation. And there is an expected return. They can go to nonprofit organizations that are operating for-profit ventures. Often in affordable housing, this program-related investment is the way that that's worked. And there also are opportunities for foundations to use program-related investments in equity. But they can all established below market returns. Individuals can do grant support, but the program-related investment thinking is primarily around the foundation world. At or above the market returns, you can just give people cash. So if you think about GoFundMe, or you think about some of the other online ways where you are doing investments like Kickstarter, those really are cash. You might get something back, or you might not get something that's equivalent to your cash investment. And the rest of these are the other kinds of investments that people can make. So if you look at this whole thing, these are the ways that the conversation begins to happen between the investor and the investee about what the guarantee is, about will I get my money back and what additional return will I get on my money. So let me flip hats now, thinking about from your side, I'm seeking these dollars from an investor. You have to begin to think through, how much do I need in this kind of money? It tends to be longer term use money. It tends to be also a longer term relationship with an intermediary or with the individual who's doing the investment. So how much do you need? Will you pay it back or not? Serious question. What level of return can you promise? This kind of level of return thinking is now dependent on you being able to do reasonable financial projections. How much do I expect I'm going to make 3 to 5 years out? How much do I expect to be able to pull from what I need to run the place to be able to return the dollars to these individuals, and when will I give them their whole money back? So that kind of thinking has to go into the conversation that you would have with an investor. Another one that is not so obvious is, what level of engagement are you willing to support? Some donors want to just get a report once a year. Some donors want a quarterly financial report. Some donors actually want to be on the board. Some donors actually want to be in on specific kinds of decisions the business makes. So thinking about the level of engagement you're willing to support is an important piece of your thinking on this. And the length of time and money that you need the money, I've already mentioned that. And then if you've got organizational structure limitations that make it difficult for you to respond to this level of engagement that donor wants, so those are the pieces that you need to think about. If you're not a nonprofit, that eliminates the program-related investment bonds. It eliminates the grants opportunities, for example. So let me give you an example of a business in the Twin Cities right now. This is Eureka Recycling. It was started as a nonprofit business to try and address the recycling needs in the Twin Cities, and solving the problem that at the point that we started recycling, it was not financially viable for business to be able to earn a significant return on this work. So right now it's a $10 million nonprofit business. It makes a profit. It feeds that profit back into mission-linked projects that are nonprofit delivered projects, including education about recycling, education about environmental challenges, and then lots of demonstration kinds of education things in schools and in the community. So they got money from people that were in their supply chain, people who provided them their trucks, people who provided them the bins, people who were actually going to be purchasing the recycled products that they were then going to be able to take and reuse. We're all investors. They found individuals who were interested in the concept, that had a passion for recycling and environmental issues, that were willing to invest in them. And they also got debt financing from some of these organizations, and also from other kinds of more structured debt refinancing products. So this is a great example of one local business that used every tool possible and did all the work walking through those questions that we just talked about, and it's very successful. So I want to dig a little bit deeper into how foundations are thinking about this. I mentioned a bit before, but foundations and I've explained what foundations are in a previous class. So foundations they have to give away 5% of the total assets they have, and their goal is to try and grow the assets they have so they continue to be able to do the 5% giving. So given that, their goal has to be to protect those assets. So that's the first premise when you're beginning to have a conversation with a foundation about making an investment in you. Protect and preserve our assets is a long-standing role. The financial staff, the investment committee of the foundation, it's realization primarily based on the idea that the initial investment that set the foundation up is all they're ever going to get. So we want to protect that as much as possible so we can keep doing this good work. The 5% requirement dictates the minimum they have to have as an income stream, and that tends to set the baseline for the kind of return that they'll be willing to talk about. And they usually need to find staff or outside consultants that help them think through this because it's not the normal staff role. So the kinds of questions that they're thinking through, and as an investee seeking their help, you have to be able to answer in the beginning of the conversation. They're thinking about how much loss is acceptable for them. And so that will be part of the conversation. The best approach is, I'll guarantee you get 5% and your money back in a fixed period of time. Here's my financials that prove it, but sometimes you can't prove it, and so you might be saying, we want you to just take a 2% return. But a 0% return starts not being very viable to talk to foundations. The second one is, how is the mission of the organization that's trying to get the money from them, even if it's a for-profit business, still, what change are you working on society, and how does that match the mission that the foundation has for its philanthropy? Sometimes foundations will have two different sets of priorities for social impact they're making, but often they're pretty much in line. They're going to want to know how you're measuring impact. Foundations have gotten deeply engaged in understanding impact with their philanthropic dollars, and they will have that same expertise about measuring impact and wanting to know the change that's going to happen. And so that driver of the conversation will be strong. And then they also need to do a lot of thinking about how much risk they're willing to take. You tie how much risk to their concept that they've got to protect and preserve the assets. And so as these conversations go on, that's always in the background. Okay. Just note that, and I've said this before, that these are actually the options that you want to think about as far as how much engagement you want from these people. Foundations structure their engagement more likely, I want to read it and maybe attend seminars so I can learn more. They probably will want to do a visit. They're not going to want to volunteer. But on an individual that's making an investment, it's much more likely you might get the answer that they want to be deeply engaged with what you're doing. So there's a whole nother piece of this puzzle. So I've just talked about here's the tools for this kind of money exchange. But there are resources now that are in place that are helping make this work, which you didn't have before. And intermediaries work kind of like the oil that gets all of the parts of this engine to really work. And there are more and more of them all the time. So these are 4 examples of intermediaries. These are organizations who know how to get access to this capital and know how to use it in different kinds of ways. Bridge to Success is in the affordable housing arena, and they literally get money from investors. They buy houses, and then they sell the houses on contract for deed to people who are in economic situations where they wouldn't meet the normal mortgage standards. That's just one example. Community Reinvestment Fund, this is an organization, it's based in Minnesota, but it's actually a national organization that was set up to take dollars from banks, and banks have a whole set of laws requiring them to do more community investment. They take those dollars and they reinvest them in local development projects, capital development for communities, retail, strip malls, apartment buildings, small business development of the buildings and structures. And so They act in a lot of ways like an investment banker might be for local community projects. Another organization very much like that is LISC, Local Initiative Support Corporation. They too do that same kind of thing with multiple different kinds of sources. The Calvert Foundation is an example of a foundation that individuals can give philanthropic dollars to, and then Calvert does the investments, and their whole portfolio is about doing investment thinking for projects, and they get their return ranges from 0 to, I think it's 8% return. So, but they use 100% of their assets this way. And North Star Capital is a more traditional investment option for people who just want somebody else to think about where to give their money, invest their money. And North Sky Capital is totally making investments in environmentally positive kinds of businesses. This example, North Sky Capital, this is growing rapidly in the private equity markets, in the banks and trust arenas that help wealthy individuals invest their money wisely. Okay, so in Minnesota, there's some unique challenges and opportunities we have. Minnesota, there's a lot of field builders that are working right now trying to help our community build. We might actually, and we've got some very progressive investors who've been thinking about this for a while and are just coming around to saying, I want 100% of my investments to be in line with my values. So there's a flood of those, and that demand is increasing. But the challenge is trying to get the match between their desire and what's out there and available, and is it possible to make it local? So that's another question people are thinking about. Another challenge we've got is we've got a lot of intermediaries that have been working in sub-industries, and I gave you some examples just a minute ago. But do we have enough? Are they working right? How can they better be coordinated? What kind of intermediaries are missing? Some of the local neighborhood development kinds of corporations, or the small business development services that are working with specific populations of color, those organizations don't quite have the right access to this capital that they need. So there isn't quite that system set up. Basically, investors are saying we don't have an easy way to find investees. In fact, I know of individual investors here who have said, I want all my money to be socially positive. They go to California because it's well organized out there and they can do that kind of investment there. So we're trying to figure out in Minnesota, how do we get that system to work here? Basically, they're saying there's too few investable deals when we've got all these people that are looking for them. So right now there's a mismatch between investor and investee. So what's happening is that there's a whole group of us that are working in Minnesota to try and build the ecosystem so it functions a whole lot better. So government is also stepping up and beginning to set government policies about the kinds of investments that happen. The Viking Stadium is a great example. The city of Minneapolis basically said, if we're going to be involved with the financing of the Viking Stadium, we want to make sure that a fixed percentage of the business goes to small business owned by women and minorities. And in order for that to work, a lot of new expansion happened with smaller businesses. So the government also can set policies about businesses themselves. The philanthropy community in the Twin Cities is also working on this. They are beginning to realize they can do PRIs. They are beginning to invest in research and invest in the development of more intermediaries. So they're beginning to play a role to get all of these things working. So as we think about this ecosystem in Minnesota, primarily in the Twin Cities, we're realizing that there are some categories of players. People who have the capital, one big category. People who are using the capital, the investees. The intermediaries that make all this work. And then the field builders, the people are making sure that the competency of the investees and the capacity of the investors are aligned, and they both are learning as this whole impact investing field develops. So there actually is a map that's being developed that is the impact investing ecosystem map. And there's a link to it. I will make sure that that's also posted on Moodle so you have direct access to that. But it is mapping all of these players and naming who the people are and how they're connected, and the organizations and how they're connected to one another. The Impact Hub MSP is the location that all this research is happening. And about the time that we are having this conversation in class, there's going to be an announcement of these are the specific kinds of strategies that are going to be acted on in order to make all of these pieces work better in the Twin Cities. And Impact Hub partners will be investing dollars to start those things. So we'll talk more about that in class. So thanks for paying attention, and impact investing is an exciting piece and an opportunity that we haven't had for social entrepreneurs up to this. Thanks, and we'll see you in class.